All right, a whole new batch of IPOs is about to drop on the Hong Kong market. And our job today? It's to run them through the gauntlet. We are going to peel back the layers, dig deep into their business models, and figure out which of these companies might actually be a smart bet, and which ones are just traps waiting to be sprung.
So that's really the big question, isn't it? With any IPO, you get hit with this mountain of information, and all of it is designed to make the company look as good as possible. Our mission here is to cut right through all that noise, find the details that really matter, and give you a clear, actionable game plan.
Okay, so we've got a few different companies entering the ring. But to really build our framework for how to look at these, we're going to zero in on one in particular, Qingsong Health. By putting this one company under a microscope, we'll basically create a toolkit we can use to size up the others much faster later on. Okay, let's really get into it. The first thing we need to figure out with Qingsong Health is what business they are truly in. Because, the story they're telling in their IPO documents is all about this big transformation. But we need to know, is it a transformation for the better, or is it just a desperate pivot?
So here's the best way to get your head around Qingsong. Think of them as a traffic monetization master. What they did, and they did it really well, was gather this massive audience of health-conscious users, mostly through their big crowdfunding platform. The initial idea was super simple. Once you have the audience, you just have to sell them something.
And that something they were selling? Insurance. I mean, just look at their old revenue numbers. The business was almost entirely insurance brokerage. And honestly, it was a brilliant model. They used their huge user base as this cheap engine to get leads, and then they'd earn these fat, high-margin commissions on every policy. It was a classic, super profitable traffic business.
But look at the company today. The entire business has been turned completely upside down. Insurance? It's shrunk to a tiny piece of the pie. And this new thing, digital marketing, has exploded to over half their revenue. They've basically morphed into a pharma ad agency. They make articles and videos for big drug companies. It's a massive, radical pivot.
So the question is, do they have a real competitive advantage, a moat, in this new business? Well, on the surface, the numbers look pretty impressive, right? 168 million users? That's a huge audience. But here's the catch. This new business is all about labor-intensive services. I mean, anybody with enough cash can go out and pay doctors to create content. The barrier to entry is just not that high. And the biggest issue of all, their main traffic engine, that crowdfunding platform, Qingsong, has been legally separated into a whole other company. Suddenly, that moat looks incredibly shallow.
All right, now this is where things get really interesting. When you start digging into the actual financials, that whole story about a brilliant transformation, it just starts to fall apart. A much more worrying picture begins to emerge. And look, on the surface, everything seems great. The company has jacked up its top-line revenue to a really impressive 940 million RMB. I mean, that's the kind of growth that gets investors all excited. But as we know, revenue is only one part of the story. And this chart right here, this tells you everything you need to know. Just look at the gross margin. It has absolutely cratered, collapsing from over 82% all the way down to 32.5%. This is, without a doubt, the single biggest red flag in their entire prospectus. It tells us that for every new dollar of revenue they're bringing in, they're keeping way, way less of it as profit. So why did the margin just fall off a cliff? It's actually pretty simple. They swapped a really high-profit business for a low-profit one. See, selling insurance as a broker, that's a low-cost, high-margin traffic business. It's easy money. But creating custom marketing campaigns for giant pharma companies, that's a high-cost, low-margin, manual labor business. They're earning hard money now instead of that easy money. And this new model, it's pushed them right into a dependency trap. Get this, over 65% of their revenue now comes from just 5 big pharma clients. So if even one of them decides to cut their marketing budget, Qingsong's revenue takes a massive hit. And even worse, they're now dependent on their old business, Qingsong Sao, for traffic, a business they don't even own anymore but still have to pay for access. Okay, so you gotta understand, this isn't just a problem with the business model. It goes way deeper, right into the corporate structure itself. We have to figure out who's really calling the shots and how this tangled web of companies could affect us, the minority investors. So the person in charge is the founder, Miss Yang, but her control is, well, it's a bit complicated. She directly holds about 21% through a trust, but then she signs these voting proxy agreements with other big shareholders. It's like she borrows their votes, which lets her consolidate her power up to nearly 34%. It gives her total control, but it's a control built on agreements, not just pure ownership.
Now, you've probably heard about this. Most Chinese tech companies use a complex legal thing called a VIE structure to list on overseas markets. It's basically a workaround for government rules on foreign ownership. But Qingsong did something pretty unusual. To get this IPO done and be fully compliant, they actually killed their VIE and sold off the sensitive parts of the business. So yeah, their ownership structure is cleaner now, but it came at a huge cost. They lost direct ownership of the very thing that generates all their traffic.
And this leads us to the million-dollar question. The company we can invest in now has to pay these other spun-off companies for marketing and traffic. But both sets of companies are ultimately controlled by the same person, Miss Yang. This creates a massive potential conflict of interest. How can we, as investors, be sure that the prices for all these deals are fair and that profits aren't just being moved out of the public company and into the private ones? All right, we have put Qingsong through a pretty tough ringer here. So let's take what we've learned and apply it to the other contenders. We can now quickly size them up and figure out a clear pecking order. So this table gives us a great at-a-glance summary. We've just torn Qingsong apart. Risky pivot, collapsing margins, you name it. Then you've got B&K Corp, which is in a solid, stable niche. It's less exciting for sure, but way more predictable. Then there's HanXBio, a classic biotech bet. It has no revenue yet, so you're not buying a business. You're basically buying a lottery ticket on their science. Huge potential upside, but also a huge chance it goes to zero. And finally, you have the stragglers. Zhihui Mining, a commodities business totally at the mercy of global prices. And Impression DHP, which is just a clear stay away. Bad financials and major red flags on governance. So after running all these companies through our fundamental analysis, the picture for a company like Qingsong looks, well, pretty bleak. But here's the thing about IPOs. Fundamentals are not always the whole story. So now let's get to the final verdict and my actual subscription strategy.
And here it is. This is the catalyst that changes the entire game. There are strong rumors in the market that 3 of these companies, Qingsong, HanXBio, and B&K, have hired what are called market cap management teams. Now, in plain English, that means they might have money lined up specifically to support the stock price right after the IPO to make sure it has a smooth debut. This instantly changes the play from a long-term investment into a short-term, speculative trade based on market mechanics.
So, with this new piece of information, our pecking order gets a major shakeup, at least for a short-term trade. The companies that are rumored to have this price support, Qingsong and B&K Corp, they now jump right to the top of our list. HanXBio, which also has rumors is a riskier biotech, sits there in the middle tier along with the cyclical Zhihui Mining. And Impression DHP? With all its problems and no rumored support, it stays firmly at the bottom. So here's the final play, and let me be crystal clear. This is a speculative punt. This is not a core long-term investment. The strategy is to spread your exposure, but to focus on those top-tier names, Qingsong and B&K Corp. Yeah, despite all of Qingsong's fundamental problems that we just went through, that rumor of price support makes it an interesting short-term trade. But I have to say it again, this is high risk. You are betting on market mechanics, not on the health of the business. And that really brings us to the final question, and this one is for you to answer. We've separated the marketing story from the financial reality, we've pinpointed the fatal flaws, and we've even uncovered a potential speculative angle. So now, with all the risks laid out on the table, is this a gamble you're willing to take? Because at the end of the day, knowing the difference between a good business and a good stock is the key to surviving in the IPO market.